Hey everyone, welcome to Accounting with Miss G. Today we're going to be looking at grade 10 balance sheet for task 11.11. Go check the earlier video. We did the income statement for task 11.11. Now we're going to dive into the balance sheet. Let's get going. So using the income statement that we did in the previous video for 11.11, we can now look at doing the balance sheet. So the statement of financial position for the business for task 11.11. All right, so if we go on to the next page, you're going to get a breakdown, first of all, of your balance sheet, looking at all your assets, your non-current and your current assets, your owner's equity, your current and non-current liabilities, and then from below, we've got our financial statement for the year end and all the notes to follow. So my suggestion would be to do the notes for the financial statement first, and then afterwards you'll be able to enter in all your amounts for the balance sheet so that you can see exactly how many assets the business has, the owner's equity, your total liabilities, and then work from there. All right, so I'm going to jump into interest income first. Interest income we did over here, and we'll see that interest income, there were two amounts, 7,200 and there was 300. This 7,200 was from interest on your fixed deposit, and this 300 was for interest on your current account. So if we look over here, interest income of 7,200 was on your fixed deposit. Let me just focus this in a bit. And interest on your current bank account was 300. So we're going to have to put those two accounts in. And your interest income on your fixed deposit, and that was 7,200, and then interest on your current account, which was 300. So your total interest income was 7,500. We already have that in the income statement, but here we're showing the breakdown of how we got to that. With regards to your interest expense, your interest expense was the interest on your loan. The loan was from Magic Bank. If we look at the interest on your loan, it was 50,300, but it also was increased by 3,900. This was additional interest that we had in the adjustment that we had to work out. Having a look and see. There we go. Number 6. The interest of 13% per annum for February wasn't included. So we need to include that 3,900 into our interest on our loan. So it was the 50,300 plus the 3,900, which is going to give me 54,200. That would have been your interest expense. There was only one amount, so the total there is 54,200. All right, so that one currently is sorted. We look onto the next page and we get our fixed and tangible assets. So for land and building, equipment, and total. This is really, really important to do obviously correctly, because what it's going to do is it's going to tell you the value of your land and building at the end of the financial year. This, firstly, on the top line, is we're looking at the carrying value at the beginning of the year for land and buildings and for equipment. Okay, so your land and buildings carrying value was 840,100. If you have a look over there, but 2,100 Rand needs to be deducted because it was incorrectly debited to your land and building, so we need to take that out. If you have a look over here, a leaky roof was repaired. This amount was incorrectly debited to land and building. So the value of the land and building at the beginning of the financial year was actually this amount minus that mistake to figure out what was that value. So if we look at those two amounts and we minus them, it's going to give you a cost of 838,000. If you're not sure how I got to that, I took the amount from the land and buildings, which was 840,100 that was recorded, and I took the 2,100 from there. That was the mistake from the adjustments that we made. Equipment, there was only one equipment amount, and that was straight from the pre-adjusted. The equipment at cost was 170,000 Rand. So I can put that over there. The accumulated depreciation would have already been recorded over here. There's no accumulated depreciation for land and building. There is only accumulated depreciation for equipment. So your land and building accumulated depreciation is 0. You can just draw a line for that. And for your equipment, it was 124,000 Rand. Remember, it's in brackets because it is going to be deducted from the cost price of your asset. So we're taking the cost of your equipment minus your depreciation to find out what is the carrying value at the beginning of the financial year we're working with. Alright, so if we look at land and building, the cost was that. There's been no depreciation, so the value has stayed the same. Equipment was 170,000 and it's depreciated by 124,000. So now the equipment amount is 46,000. The total column, we from there are going to have to work out how much in total the cost of assets is, and then looking at the total amount for accumulated depreciation. Just trying to find my calculator. Got it. There we go. Okay. So the total cost was 838,000 plus 170,000. So the total value of the cost price, or the cost value of the assets is 1,008,000. The total accumulated depreciation, there was only one amount, was 124,000. Remember in brackets because we're going to minus it from the total. That's 124,000. So that minus that gives me 884,000. So that is the carrying value of all the assets. This is considered your fixed assets. In other words, your non-current assets. These are your non-current assets. This is the total amount you had at the start of the financial year. Then things happen throughout the year. From the 1st of March to the end of Feb, things happen to your assets. Either you would buy more assets or you would get rid of assets, sell them, you decide to replace others, and then depreciation takes place. According to this activity, they did not buy any other assets throughout the financial year. So there was no additions at cost, and there was no disposals, so no selling of assets. But there was depreciation that took place. If I look at the question, it speaks about depreciation on equipment for the current year amounts to 4,600 Rand. So that's on equipment. So that depreciation is going to be 4,600. According to the activity, there was no depreciation on land and building. So your total amount of depreciation, if I'm adding it up across, no depreciation for land and building plus equipment gives me 4,600. When we look at your movements, they want to know, there actually should be a line here to make it easier for you to understand. For your movements, what was the totals? The totals for equipment was 4,600 because that's all there was. And the total for your depreciation was 4,600 as well. Okay, so that's all that depreciated throughout the year. The carrying value at the end of the year now is looking at, all right, you've had these land and buildings and these equipment for another year. How much have they depreciated by even further? So for the cost, We'll enter in the cost again because there was no additions at cost, so the amount would stay exactly the same. So they still have 838,000 rands worth of land and building. It was 170,000 rands worth of equipment at cost, which we know was 1,008,000. But the depreciation or accumulated depreciation that would have happened is what you need to work out. And accumulated depreciation would be the depreciation that's happened so far, plus any extra that's happened in this financial year. So it's 124,000 plus your extra depreciation is going to give me my 128,600. In total, my depreciation again, the total amounts just so happen to be the same because there was no land and building depreciation. Add those two up, it's 128,600. So what they want to know now is what is the carrying value at the end of the financial year? So on the 28th of Feb 2017, what was the carrying value of that asset? All right, so we're going to take our cost minus accumulated depreciation for land and building. There wasn't any, so the value has stayed the same. The cost of 170,000 for equipment and the total depreciation so far for the entire time they've had that asset is going to give you the value of it now. And just over R1,000,000 worth of your assets minus all the depreciation you've experienced while owning those assets is going to give you 879,400. This amount over here is really, really important. We're going to use that just now. Okay, so don't forget about that one. We keep moving on and we work on to inventory, trade and other receivables, and cash equivalents. These are all considered your current assets. All right. So two things that would have to go into inventory. Firstly is your trading stock. Your trading stock that they had according to the pre-adjusted, let's have a look over here, was 202,000. But remember 15,000 was taken out. Why? Because of drawings. So it's 202,000 minus the 15,000 for drawings, and then minus lastly, and we mustn't forget, is your trading stock deficit. And this one was for drawings. So in total, we'll see that 202,000 Rand was what was recorded that we had. 15,000 was taken out for drawings, and there was a deficit, a shortage of 3,500. So the amount of trading stock that we have left over is 183,500. Another inventory account would be consumables on hand. If we look at question 2, it says consumables on hand was 1,400. So we can just enter that consumables on hand of 1,400 straight in. So in total, our inventory amount was 184,900. Next thing we look at is trade and other receivables. So one of them being your trade debtors or your debtors control. So your debtors control was 35,000 according to the trial balance, minus the 400 Rand from bad debt. Okay, so the amount that they would then receive or should receive from their debtors is 34,600. Trade and other receivables, there's two others. One of them is income receivable, and the other one is prepaid expense. So income receivable would be a scenario where they received money, or they are expecting to receive money and they have not received it yet. So fee income of 5,000 was received, it was only banked on the 1st of March. Okay, so it was banked in the wrong financial year. It needs to be moved into the current financial year. So this is considered income receivable. That income receivable is 5,000. Prepaid expense would be something that you've paid for in advance. And if I remember correctly, that was your insurance amount. The insurance premium was paid in advance during February of 800. So that's going to go over there. Remember, all of these accounts over here are essentially assets. They are all your current assets. So if we add those three up together, it gives you 40,400. The next three, bank, petty cash, and cash float, also current assets. You'll be able to receive that from here. Your bank amount was 28,020. Petty cash was 2,000. Cash float was 1,000. So let's enter that in. All right. So if we add those all up together, that is going to give you a total of 31,020. That's your total cash and cash equivalents. When we're looking at owner's equity and the balance at the beginning of the year, we need to look at your capital. So if we look at your capital, what they're saying is at the end of the financial year, it was 820,000 Rand. We need to know what it was at the beginning of the year. Is it the same? It says you're halfway through the year, Malcolm provided extra capital of 40,000 Rand. This has been properly recorded, which means in that 820,000, 40,000 Rand has been put in there because this is at the end of the financial year. So how do we figure out what it was at the start of the financial year? You're going to take your 820,000 and you're going to minus the 40,000 that the owner contributed into the business. Okay, that's going to give you the correct capital at the start of the financial year. Your net profit for the year is going to come from your financial statement. Looking over here, looking at your income statement at the bottom, it was 197,000 Rand. So that I'm going to put in over there. Then we need to look at, was there any other capital that was added? Yes, there was. Remember, he put that 40,000 Rand in. So the 40,000 we deducted there to find out what it was at the beginning. We need to account for it. So this is additional capital contribution. And that was 40,000. Lastly, the last thing that's going to affect your owner's equity would be drawings. All right. If we look at our drawings in our pre-adjusted, the drawings amount was 204,000, but we know that there was more drawings because they took trading stock. So we're going to add that 15,000 over there. That's going to give me 219,000. So looking at it in total, your balance for the year, this is your capital at the start of the year, the money that you've made throughout the financial year after all your expenses and everything have gone off, and additional capital. Add those three together and minus your drawings, because that's going to have a negative effect on the owner, and you're left with 798,000 Rand for owner's equity. Okay. Last account we're looking at is your trade and other payables. So these kind of things are your current liabilities. So in other words, something that is less than 1 year that you are going to pay for this amount. So it's payments that need to be made within the next financial year. So remember, the financial year we're working with over here is 1st of March to 28th of Feb. So from the 1st of March 2017 to the end of Feb 2018, that would be what we're looking at over here. All right, your trade creditors. Your creditors control we're looking at was 65,000. Another one we would have is income received in advance. An amount that you received in advance was that rent income where the person went on holiday. Let's have a look here. The tenant paid rent for March and April in advance because they were going on holiday, and that worked out to be 6,000. And then we have expenses payable, so things that you still need to pay for but you have not yet paid. Notice these are all liabilities as we're going, current liabilities. Alright, so your telephone of 820 and your advertising of 2,000 are the two things that you still need to pay for. So you have 2,820. Now there's a slight mistake here in the answer booklet. There's one account that still needs to be included. So the total is actually going to go over here. The last account we need to look at is the current portion of the loan. So in the next financial year, the business is going to reduce the loan over the next year. The loan will be reduced by 30,000. So this is considered a current liability. Why? Because it's within the next financial year that this loan is going to be reduced by 30,000. We must keep that in mind later when we're looking at the balance sheet. Okay, so just a reminder, these are your current liabilities, things that are going to be paid within the next financial year. Anything longer than that, or so further than the next financial year, will be considered a non-current liability. So trade creditors, 65,000, income received in advance, 6,000, expenses payable, 2,820, and your current portion of the loan, which you would be paying, is 30,000 in the next financial year, is going to give you a total of 103,820. Alright, so now that we've done all of that, I know, deep breath, okay, we are going to put all that information into the document to obviously help us out. Okay, so we've done that one, page 21, 22, and 23. So the statement of the financial position, we're going to use all the things that we've worked out and calculated now, and we're going to enter it in over here to see at the end how the business did. Alright, so your assets, your fixed and tangible assets, your fixed or tangible assets, remember I said to you, don't forget this amount over here, it's really important. Your fixed and tangible assets, this is the amount we're looking at, the total carrying value at the end of the financial year. So that would be 879,400. Alright, the next one we're looking at is your financial assets. So what else you might have had that is of value to the business. And the one thing that you did have was your fixed deposit from Magic Bank. Alright, and your fixed deposit amount that we're looking at is 100,000. That comes straight from your pre-adjusted. Alright, if you look in the note column, this would be something that's new to you. Your fixed and tangible assets, you're going to need to write down a note as to where you found out that amount from. So when we look at that and we look at your document, we look at number 3, that is considered the note. So this would be number 3. There is no note for your financial assets, that just came straight from your pre-adjusted. Your current assets we'd look at next. So your current assets amount comes from your inventory, and that is over there. So your inventory, which is note number 4, that total is 184,900, and that comes from note number 4. The next current assets are trade and other receivables, and that total is 40,400, and that's note number 5. The last one is cash and cash equivalents, and that is 31,020. Okay, so now we've entered in our non-current and our current assets. We need to just look at what is the total for our non-current assets. So it would be these two together, which gives me 979,400. What is the total for my current assets? And apologies, your cash equivalent note over here, let's not forget that, is 6. If I add these three up together, it's going to give me 256,320. So to figure out your total assets, you're going to take your non-current assets plus your current assets, and that's going to give you your total assets, which is 1,235,720. Next thing we look at is your owner's equity. So your owner's equity amount you're going to also be able to get from your notes. Note number 7 tells you that your owner's equity is 798,000. So we're looking at note 7, 798,000. Your non-current liabilities, so things that you would pay for that are longer than a year, would be considered non-current liabilities, are firstly your loan from Magic Bank. The loan from Magic Bank total was 360,000. We then need to add our interest of 3,900, and then we need to minus the 30,000 that is going to be paid in the next financial year. Remember, non-current liabilities is going to be something that is longer than 1 year. So non-current liabilities, if it's longer than 1 year, then it needs to be worked out here. The 360,000 plus the interest minus what you're going to be paying in the next financial year, so that's less than a year, that would be considered your current liability, would need to then be entered in. So once we've entered all of those amounts in, it's going to give you 333,900. So your total non-current liabilities are going to be the same. Your current liabilities, which is the last note that we have, if I look at your trade and other payables, note number 8, these are things that are going to be paid within the next financial year. So trade and other payables, and that amount is 103,820, and that would give you the total of 103,820. All right. So remember, I realized that I got to this sound entirely wrong. I'm going to save myself here. If it is less than, so less than 1 year, it would go here. So in the next financial year, they're going to have covered this, because that is your current liabilities. If it is longer than 1 year, so even into the next financial year, it would be over here as your non-current liabilities. So your total equity and liabilities we're looking at is taking your owner's equity and your current liabilities as well as your non-current liabilities, and calculating your total equity and liabilities. And that amount total is 1235720. If you have a look, your total assets equals to your total owner's equity plus your liabilities. Because remember, when things were simpler, the accounting formula in grade 8 and 9, assets equals to owner's equity plus liabilities. Your total assets equals to your total equity plus your liabilities. Right, so just a reminder and a refresher after everything. You start off with a pre-adjusted. You will look at your adjustments and make notes of them over here, just to ensure that you've done everything and you've covered everything that's needed. Be sure that you look at any extra notes that are given to you over there. You're then going to enter everything into your income statement, and you're going to use this net profit later on when you are doing your owner's equity in your balance sheet. You're then going to look at entering in all your notes first, so all your interest income, all your interest expense, fixed assets, inventory, trade and other receivables, cash and cash equivalents, all your current assets, your owner's equity, and then lastly your current liabilities. Once you've entered all those in, you're going to use those totals and put them into your balance sheet. So essentially you're going to have all your assets would equal up to all your owner's equity plus your liabilities. Thank you so much for watching the video today. Please don't forget to subscribe and click the bell for notifications so that you are notified anytime I upload any more videos. I hope this video worked on income statements and balance sheets. I know it's information overload, but just work through it slowly. And remember, you've got this.